How to invest in the stock market. Learn all types of investment. Section 1, Basics of investment in the stock market. Section 2, Different styles of investing in the stock market. Section 3, What investment style suitable to me and how to invest. Hi, I am Vishweshwar, founder Showmytrade.com, ex-investment banker, professional stock market trainer, trader and investor. Section 1, Basics of investment in the stock market. We invest in the stock market for wealth creation or grow our money, right? So we need to study the business of a company. It means our business is to study the business of other companies, right? We try to figure out what is the company's product or service, customer base and growth rate, pricing power, quality of management, competition, the financial performance of a company, sector analysis that company belongs, government policies which affects the company, etc. Studying and understanding the above information of a stock or a company is called a fundamental analysis. It helps us to identify the opportunity for good investable stock. Fundamental analysis is an in-depth analysis of economy, industry or sector, company, or what we call it as a EIC analysis. The aim of the fundamental analysis is to find out fair value of a stock. If a fair value of a stock is undervalued, then the current market price, we buy the stock. If it is overvalued than the current market price, we may skip the stock. Further study: time value of the money, opportunity cost, risk-free rate, equity risk premium, the beta, risk adjusted return or Sharpe ratio. How to choose a stock for an investment? Let's look at some of the points we consider to buy a stock. Number 1, economic mode or distinct business model of a company. What is the company natural advantage enjoying? Is it one of the top 5 companies or one of the largest or the biggest, profitable, near monopoly, or it is working in a particular niche? Such thing we study about that company. Advantages of such companies are good customer base. We can expect to continue the same or better performance. Unique selling proposition or competitive advantage. Company is changing with times. Good management and talent. Well-defined the systems and procedure. A company can exist in a perpetuity. There are many companies which are 25, 50 or even 100 years old. Number 2, good fundamentals. Let us learn some concept and important financial key ratios. Number 1, equity per share or EPS. How much a profit per share of a company? Earning per share EPS is equal to net profit minus dividend from preferred stock divided by average outstanding share, or how much a company is issued the outstanding share. Example, a company makes 100 crore profit and outstanding shares are 20 crores. That is 100 divided by 20 is equal to rupees 5 per share. We check past EPS for the last 5 years. If the EPS of keep on growing for all these 3 years, it is an excellent sign. Suppose the EPS is continuously erratic or falling year on year, in that case we should better look for the another investable company. Number 2, price to earning or PE ratio. What price do you pay to earn the EPS of the company is called a PE ratio. It is nothing but earning per share whatever company is enjoying. To buy that share, what is the current market price you have to pay? That is what is called a price to earning ratio. Price to earning ratio is equal to current market price divided by earning per share. For example, a company current market price is rupees 100 rupees and EPS of the company is 25, that is 100 divided by 25 is equal to 4 PE or 4x. As a thumb rule, low PE ratio is preferred while buying a stock. However, the definition of the low varies from industry to industry. We usually compare the PE among the same sector, not with another sector. For example, if we are trying to find out the low PE of IT companies, then we compare with the other IT companies only. Number 3, price to book ratio. The price to book ratio indicates how much shareholders are paying for the net asset of a company. Price to book ratio is equal to current market price divided by book value per share. Generally, a lower price to book ratio could mean that company is undervalued. Number 4, debt to equity ratio. It is a ratio of the company's debt to the share capital of the company. Debt to equity ratio is equal to total liability divided by total shareholder equity. Example, a company has a rupees 25 crore loan and share capital is rupees 50 crore. That is 25 divided by 50 is equal to 0.5 or debt equity ratio is 0.5:1 ratio. As a thumb rule, companies with a debt to equity ratio of more than 1 are risky, should be considered carefully before investing. Debt to equity ratio should be less than 1. Warning: the modern fund manager is okay with the high debt to equity ratio as the interest rate in the economy is very low or falling. The debt can bring more growth to the company. Suppose a company grows much faster than the interest rate, that is say 17 to 20+%. Number 5, return on equity. It is a ratio of net income return as a percentage to shareholders' equity. Return on equity is equal to net income divided by average stockholders' equity. As a thumb rule, always invest in a company with a ROE greater than 15 to 20 plus for last 3 years. The increasing growth rate of ROE is a good sign. It means management is using the capital very prudentially. Number 6, price to sales ratio. The ratio measures the price of a company's stock against the annual sales. Price to sales ratio is equal to current market price divided by annual sales per share. The smaller the value is preferred. A price to sales ratio is better tool because sales figures are considered to be relatively reliable. Number 7, current ratio. The current ratio indicates the company's liquidity. How much the current asset of a company are available to cover the current liabilities. Current ratio is equal to current assets divided by current liability. It indicates short-term liabilities with its short-term assets. If a ratio is over 1, the company is comparable meeting its short-term debts. Number 8, dividend yield. What percentage yield a stock can give? Dividend yield is equal to dividend divided by current market price into 100. Example, a company declares rupees 5 rupee dividend. The current market price of the share is 500. That is 5 divided by 500 into 100 is equal to 1% dividend yield. As a thumb rule, the consistent or growing dividend yield is very good sign for the dividend investor. All the above ratio we need not to calculate. It is available on many websites. Let us go to this screener website. We can type, let us say, Infosys, and can find out all this data. Number 3, quality of management. Quality of management is an essential factor while investing in any company. Management is a big differentiator, isn't it? Warren Buffett, the world-renowned investor, says, ordinary product and extraordinary management will do better than extraordinary product and ordinary or poor management. Good management can take the company to new heights. On the other hand, bad management can lead to the downfall of a company. Do some research and find out who is running the company. One should know the key executives, CEO, MD, CIO, and qualification, integrity, strategy, transparency, and past experience of the executive or management. Further study family management or a professional management, integrity of a management, past record of a management, how does the management fare in the adversity. Number 4, does the company have a big debt? Owning an equity share in a company means we are the partial owners of the company, isn't it? We realize the profit only after company clearing the debts because we are the owner, right? The company takes the loan either for working capital or capital expansion. If the company has a significant debt, then the stock price will not appreciate much in the stock market. Avoid investing in the companies with a significant debt. Further, while investing in the companies in the banking sector, avoid companies in the banking sector with a huge NPAs. Section 2. Different styles of investing in the stock market. Various styles of investing will help us to understand the subject in more detail. One can choose the type of investment that works. Number 1, growth stock style. In the growth investment approach to the fundamental analysis, the investor tries to find out the high growth in the business performance in the future. Once the investor has chosen such company, buys its share, the investor expects to benefit from the future high growth of a business. The investor would focus on the company's product, target market, distribution channel, customers, management, financial, etc. The investor wants to know the strength and sustainability of the business in the long run. The aim here is to find out the company that will increase its earnings, market share, pricing power, differentiated product or service in the future. Large investors prefer a growth stock which ultimately results in re-rating. Such a company's PE ratio will result in multi times to their earning in valuation. Example, FMCG, IT, pharma, etc. companies. Number 2, value investing. In India, we call it as a Contra investing style. In value investing, investor will find out the fair value of the company share. Analyzing the various business and financial factor and calculating the fair value of a share, compare with the current market price of such a stock. Suppose the investor figures out that company's current market price is lower than the fair value of its stock and buys the shares of a such value company. The investor expects a good return from rising price of such stock when the market discovers that discount is in the stock value and increases the stock price to its fair value. Investor focus on the asset quality, earning potential of the companies, then tries to find out the stock price at a discount of a fair value. The deeper the discount can be, the better is. Number 3, index fund style. Index funds are a source of investment for investor who wants long term but don't want to take more risk. The index funds are relatively low in volatility compared to the other product. Therefore, the index funds are excellent choice. In index fund, investor proportionately match the index. For example, in India, Nifty 50, investor match the Nifty 50 share components. Many mutual funds use the NSE index for promoting various mutual fund schemes. Some of the funds: Birla Sun Life Index, DSP BlackRock, Franklin India, HDFC Index, ICICI Prudential, LIC Mutual Fund, etc. Number 4. Momentum investing style. Momentum investing is a style of investing stocks or securities with high returns over next 3 to 12 months, and selling those gives a poor return over the same period. Here investors try to capture momentum usually for a short term. Some big investors identify the momentum in any asset class and invest until the momentum lasts in any country or any index. Number 5. Yield investment style. In this style of investing, the fund manager generates above the market or benchmark index income. Yield is a forward looking. It measures income such as interest and dividends. The yield investment style ignores the capital gain. The yield focused for a specific period, annualized returns such as the interest or dividend. Number 6. Structured investment style. In this style, the investor is made to suit the investor's specific risk and reward parameter using the sophisticated investment tool and financial product. Structured products are pre-packaged investment that typically include assets or a derivative product. It generally tracks an index or a basket of securities and is designed to facilitate highly customized risk-return objective. Number 7. Alternative investment style. An alternative investment is also a financial asset, but that does not fall in the conventional investment such as equity, interest, or any other cash product. Some of the alternative investment examples are private equity, venture capital, hedge fund, real estate, property, etc. Alternative investment tend to be somewhat illiquid. An alternative investment also invests in the non-conventional product such as weather, art, wines, etc. Section 3. What is investment style suitable to me? The investor has a multiple choice of investment based on understanding of a product, risk to reward, whether low risk, low return, moderate risk, moderate return, or high risk, high return, duration of investment, whether it is a long term, which is called an investment, or short term, which is called a trading activity. How can I invest? Number 1. Direct investment. The investor does the research, decides on what to invest and timing of entry and exit. Here the investor learns the stock market, practice and analyze what type of investment trading style works for him. The trade executed through the brokers who are the members of the stock market. Broker often provide the research-based reports on stock and investment climate, which investor may use. Number 2. SIP, Systematic Investment Plan. Systematic investment plan is also commonly known as SIP. SIP plans allow you to periodically invest fixed amount in your either stock, index, mutual fund schemes. Here the objective is to save an investment. Number 3. Investment through the Portfolio Management Service or PMS. A PMS is offered by many banks, broking house, mutual fund and others. A discretionary PMS provides the benefit of professional management of a portfolio with the decision taken by the portfolio manager. Or a non-discretionary PMS where the portfolio manager will provide the advice and information to the investor who will decide the investment choice and timing. The portfolio manager will execute the decision taken by the investor. Number 4. Investment through equity mutual funds. In mutual funds, a fund manager creates and manages the investment according to the objective of the such scheme. The investment objective will define the asset class the fund will invest in, such as equity, debt, gold, or combination of assets, and strategy adapted to manage the portfolio. Various schemes focus on market segment such as large, mid, or small cap sectors and different strategies and investment style. Learn and understand the various types of investment and figure out which style works for you. Good luck in the journey of investment. Kindly subscribe, like, share with many others of Showmytrade channel for more videos to follow. Together, we build a strong financial India. Thank you.